Hi, today's lesson is on debt ratios. Debt ratios are used throughout the mortgage industry to help underwriters and lenders make a decision how much money a borrower can afford to borrow. So a relatively straightforward concept, but one that you sort of need to make sure you understand as you sort of approach your decisions. All right, so the basic answer is the percentage of your income that's going towards your housing. And so the way you sort of determine that is you take your monthly housing expense, which includes something that's commonly called PITI, which is another term you may hear, which we'll deal with in a different lesson, but principal on the mortgage, interest on the mortgage, property taxes, home insurance, and mortgage insurance, if that's applicable, all go into that monthly housing expense. So that's the cost of owning the home, all right? You then divide that into the gross monthly income, and that becomes your front-end ratio. Okay, so there's two different ratios lenders can look at. It's again this front-end one, which is the monthly housing expense divided by your gross monthly income, and then you're going to add in all the required monthly bills, things like your car loans, student loans, credit cards, and other stuff in your life. You're again going to take that and add it to your housing and divide it by your income to get what's called then your back-end debt ratio. And so you have two different ratios that come together. So then the next obvious question is, well, what should it be? What's ideal and where can it go? So we always talk about the world of eligibility versus the world of suitability. What that means is lenders were going to lend you up to 38 or 45% on the front end, and maybe even 50% of your overall expenses could go toward your housing on some programs. Suitable obviously varies from person to person. But in terms of having the ability to do other things in life, saving money, and doing other financial things, it is ideally probably somewhere between 25 and maybe 30% on the front end ratio, and maybe 32 or 38% on that back end ratio, with some flexibility given if income's going up and some different things like that. So a quick example: a $2,000 housing expense divided by $5,000 a month in income would obviously give you a 40% front end debt ratio. Let's say you got a car loan of $300 and a $200 car loan. You add that together, you got $2,500 a month going out there, divided by 5,000 again, and what gives you a 50% back-end ratio. So in that example, your ratios are 40 over 50. It may get approved, but it could be somewhat financially painful if there's no sort of plan to get rid of debt and or income going up over the next couple of years. All right, so thanks for listening to today's lesson.